Alright, today we're going to be going over another one of my subscribers' portfolios, and today we'll be going over SQ Williams' portfolio that he sent in to me, and I think this is going to be one of the most impressive ones we've done yet. So we'll be going over all of his holdings today. I'll be sharing my thoughts, what I'd like to see more of, what I'd like to see less of, and so much more. Also, he's going to be getting an added 3 points to his portfolio grade at the end of the video because he's a channel member. Also, if you want to go the extra mile, become a channel member today, get exclusive episodes. You can also get access to a stock market competition that we have coming up in the next 2 months. If that sounds like something you'd be interested in, you really want to go the extra mile to help the channel grow, I'd appreciate that a lot. If you want to check that out, links in the description. With that said, if you aren't already and you have to pay your toll here, you have to hit that subscribe button for me and smash the like button. With all that out of the way, roll the intro.
Hello, I like money.
Alright, before I like to go into the portfolio itself, I like to know the investor's age, goals of the portfolio, etc. So I asked him, he said he's 21, so my goals of the portfolio is to grow as fast as possible, funnel all my income into stocks while keep spending as low as possible. He wants to retire early, guys. Hopefully by his early 30s, he said. He invests a minimum of $1,000 every month, whether aimed at Merrill Edge or M1. And in the beginning of this year, he decided to invest more for dividends and focus on quality, which is an amazing way to go about it. And his current goal is to figure out his career path. He decided he was going to university in 2020, but he didn't know what his interests were, which may have been a mistake as it limits his future projected income. He'd been able to find a sector, but it's definitely something he said he's not interested, at least long term. Alright, life advice Ryan Dangler is coming in here to kind of help you out with this, and this is just my own 2 cents of what I do. So you're obviously working for the bag, and that's the great way to go about it. You're keeping spending as low as possible. Hopefully you're living with your parents still, saving or at least sharing with a roommate or something, getting that rent cost down. That's definitely the way to go about it right now, at least. So right now, I would recommend trying to find a side hustle or another source of income that you're really passionate about. For me, obviously what I'm doing right now is YouTube, but for you it can be something else. Just find something on the side that you can envision really growing as a business overall long term, and just doing it on the side, and make sure you're passionate about it, because you're going to have to obviously dedicate a good amount of time to it. But I do think it is really solid that you're investing that amount every month and trying to be as frugal as possible. I would say be frugal to a certain extent. Don't be like Graham Stephan and be, living off of pennies for groceries, that. And, you're overall in the long run, you're still really young. 21 is when a lot of people, a lot of people start investing at 21, 24 years old. So, you're still young overall, and you get a lot of knowledge, obviously by watching this channel. Alright, let's move on to the holdings, the bread and butter.
And hey you, right there, do you want me to go over one of your portfolios? Join the Discord link in the description and message me from there. On to the video.
Alright, so he's got 2 portfolios that we're going to go over today. This is pretty much his growth portfolio, and it's the bigger one also. It has a value of $96,270.66. Now, I can understand how he affords that membership every month on the channel. In all seriousness, though, that's really impressive, especially, for being 21. So props to him to start off. We can see it right now. It has an unrealized gain of $6,408.84, or 7.13%. Now, I don't know how long the portfolio's really been up, but that's pretty solid in my opinion, with his biggest loser being Alibaba right now, which is kind of dragging down the portfolio at 36%. Now, if you told me you're living off of dividends, and this is obviously the bigger portfolio compared to the other one, these obviously aren't the highest dividend stocks, quote unquote, but they're definitely quality. We'll start off with Apple, stock ticker APL, and right now he is up 31.4% on Apple. Apple's obviously one of my favorite positions right now, and it's one of the smaller ones in his portfolio at the moment. Apple's just such a high quality company. Every time you think Apple can't make a better product, they make a better product. I'm a huge fan of the research development. Their share buybacks are insane, and everything is amazing about Apple, except the dividend growth, of course. Apple's the 4th largest holding in his portfolio out of the 5 here. He's got some solid gains on Apple, so that's very good to see. Alright, next, the 2nd largest holding in his portfolio is Amazon, stock ticker AMZN. Now, me personally, I'm just avoiding Amazon. I do think that they're an amazing company. With that said, though, they aren't profitable right now. They're actually in the free cash flow negative side of things. And I don't completely understand the business. I've never done full research on it. With that said, though, it seems that it has worked for you, as you're up 40.45% on the position. Now, with Amazon, I would consider potentially trimming here. Obviously, you're up a lot in the green, but if you would consider trimming, I would recommend allocating those funds to the other portfolio, which is the more dividend-oriented portfolio, and you could try to get that dividend income up, especially if you're trying to retire in the next 10-15 years. Me personally, I don't own Amazon right now just because I'm the free cash flow negative, and it doesn't really meet my requirements for being an investment at this point in my life. They don't pay a dividend. Obviously, dividends aren't everything, but they aren't also positive in the free cash flow department, so that's a big thing too. Next is a company that I have mixed thoughts on, which is Alibaba, stock ticker BABA, and that's his biggest loser at the moment, but it also is one of the bigger positions when it comes to his cost basis. He's down 36% on it right now. Obviously, China's had a big question mark on it for a while now, as I'm aware of that with Starbucks. Me personally, I'm avoiding Alibaba. I just don't completely love investing in China. I get enough exposure already with Starbucks. I'm avoiding it. But if you have a good thesis on it, I would consider averaging down. And if you really do believe in the company. Alright, so that's a no for me from Baba. But again, he probably has his own thesis and he'll prove me wrong in the comment section. I'm sure he'll be there to answer any questions. Next, he is my next employer pretty much, which is of course Google. Currently by market weight, Google is the biggest position in his portfolio, sitting at $31,893.09. And right now in his Google position, he's up a nice 19.5%. Now, I own Google in a portfolio that I help manage for one of my relatives, and I love it so much as a company. Unfortunately, I don't own any myself, but I will eventually love to buy some. I think Google owns the most valuable content platform in the world, which is, of course, YouTube. I don't think anything will ever really be able to compete with YouTube. I think it would take a lot for a lot of big YouTubers to actually go off of YouTube. I know it's a very cyclical business when it comes to ad revenue and all, but I just don't see other platforms really competing. I know there's Rumble for free speech or whatever, but I don't really see that being much of a dent in YouTube whatsoever. And obviously, you're pretty much investing in me without actually investing in me. You're indirectly investing in the channel. So, of course, I'm going to say yes to that. But I really do like Google as a company financially, and they check out. I like them a lot. Will they ever pay a dividend in the future? I guess we'll never know. And obviously, their search engine's a giant, so I really like Google long term. I'm going to personally be doing more research on Google in the coming months. Will I add it to my portfolio at the right price? Absolutely. Google also has been buying back shares as well. I really like Google as your number one spot, and I definitely approve of it. Next, as his smallest spot in the portfolio, unfortunately, it's Microsoft, stock ticker MSFT, and currently in his Microsoft position, he's up to 28%. Now, if you're a viewer on this channel, you guys should obviously know my thoughts on this next company, which is, of course, Microsoft, stock ticker MSFT. I love Microsoft. I think it's the best quality company in the world right now. They have a growing free cash flow, growing dividend. They also do buybacks, and it's just a behemoth of a company. Not to mention, I think they also have potential to be the largest gaming company in the world. They just whooped the FTC a few months ago on their Activision Blizzard deal, and it looks like it's going to go through, pending in the US, of course. Now, obviously, with Microsoft, it's the smallest position in your portfolio with these other top 5 tech giants on here. With that said, though, I would like to see you add more to Microsoft. I'm sure he's waiting for a dip, though, as it has been trading up a lot recently. Microsoft's a very strong dividend grower as well, so I could see you adding that in your dividend portfolio that we're about to go over as well, but I definitely approve of this Microsoft position. I would like to see you add more on a potential dip. This video is sponsored by DividendData.com. If you wonder how I have all this knowledge at such a young age, the reason is because of DividendData.com. Compared to other online free resources, a lot of the research on these companies would take over an hour. With DividendData.com, it's quick, simple, and I can research a company's financials in less than 5 minutes. Not only can you research stocks on there, you can also do future value projections with your own calculators, your own growth numbers, etc. And you can also have valuation metrics on companies that you're looking to potentially add to your portfolio. It's an all-in-one tool, and it's still expanding right now. If you want to try the tool out to see if you like it, you can try it for 2 weeks free without charge. The link is in the description onto the video. Alright, now let's move on to his retirement portfolio, which consists of 10 positions of a cost basis of $9,044 right now, and he's currently up $994 on it, or nearly 11%. Pretty solid gains overall. This is obviously the portfolio he was talking about that he eventually wants to live off of, so I would consider, potentially transferring some money from the other portfolio, which is worth $100,000, maybe to this one if you're really trying to get that dividend snowball rolling. But let's get into the holdings. To start off, he has Lowe's, which currently is up 18%, and he has $589 in Lowe's at the moment. Lowe's is a very strong dividend growth company, but I do have concerns what would happen if we were to go into a housing market or recession or something that would go really bad with the real estate market. I think that would obviously impact Lowe's and Home Depot. Lowe's and Home Depot obviously have a duopoly. With that said, though, if something were to potentially happen to the housing market, I think that would be a great time to buy. Those would obviously be stocks on discount at the time. It looks like a very cyclical business to me, just a business that I would ideally want to be in. I'm doing more research on Lowe's and Home Depot at the moment. I don't have any eagerness to buy, even though their dividend growth is very strong. I wonder how sustainable it will be at like those 15 to 20% ranges. I do think that they're a very strong business overall, though, in long term you'll do well with it. I am curious to hear your thesis on Lowe's, why I do Lowe's over Home Depot. Just very curious on that. Alright, moving on, sitting at $594.54 of his portfolio, we have the giant Intuit. Intuit's basically a toll booth business. Toll booth businesses like Visa, MasterCard, Intuit, S&P Global, they just sit there, collect fees. Very simple business, reoccurring revenue streams. They got pricing power. Intuit, I believe, is a very strong business. From what I've seen, at least, I haven't done full research into the company. Intuit's a very high quality business from my looks. Obviously, me personally, I don't own any because I haven't really done full research on the company. And right now, at least, since I haven't done that full research, I don't fully understand it. So I'm not eager to buy any at the moment. But it's a company definitely on my radar that I'm watching and researching at the moment. Intuit also has paid a very strong growing dividend as recently with the recent hike being at 15%. Looking at their buybacks, they historically have bought back shares, but recently they've had some dilution, so I'm a little curious to why that is. Right now, he's got really solid gains on Intuit as well, as I mentioned, up 17.54%, so very solid gains there. I'd like to see you continue potentially adding to this company. I do think it's a very strong holding from what I've seen. At the right price, though, it's obviously been on a bit of a price hike as of late. Alright, next is a bit of a smaller holding in this portfolio as well. We got Microsoft. I obviously spewed my thoughts about Microsoft. In this portfolio, he bought at $284.13. A little lower than what it's at today. He's up around 15% on this part of Microsoft. Again, if Microsoft were to potentially go on a dip, I'd love to see you add here. Next, he has MSCI, another financial services company. Just seems to be one of those tool booth companies that as I mentioned earlier. I haven't done full research on this one, but I am noticing a bit of a worrying trend here that our good friend Alex Rezzi on the Discord would know, which is potentially copying Joseph Carlson's stock picks. Now, there's nothing wrong about getting exposure from other YouTubers on different stocks. I'm guilty of it myself. But there are some trends here. I'm not saying that he's copying whatsoever, but of course, anybody be wary of copying YouTuber stock picks. Don't do it. In this case here, I think YouTubers should give you exposure to different companies to do your own process and research on, and I think that's how it needs to be viewed. Overall, I haven't done a lot of research on MSCI, so I can't make a legit comment here, but looking financially, they look very strong. Next, he's got one of those tech company holdings here, which is Apple, stock ticker AAPL. Now, in this position in Apple, he's up 13.7% with a cost basis of $161.92, which I think is a pretty solid price. Apple, as I mentioned, I would love to see it go on a dip potentially, 170s, 160. I'd love to scoop some up there. Apple's such a strong company. As for dividend growth, I don't know if it's the best one yet, but I think over time they could potentially have a crazy growing dividend if they can't allocate that money in R&D or buybacks. Alright, a non-tech company, and it's the largest holding in its portfolio, which is Union Pacific, stock ticker UNP, and it makes up a wide range of his portfolio, currently sitting near 39% of the portfolio at the moment. This is pretty large for any individual holding. I'd like to hear his bull thesis on UNP. With that said, though, it has done pretty well for him recently with the new hiring a former COO as the new CEO, Jim Vena, who apparently is going to turn this company around, guys. But in all seriousness, when UNP had Lance Fritz as CEO, I thought their performance and business execution was pretty solid. But it wasn't until they were called out by an investment firm, basically called out for horrible execution, and they made the CEO resign, which they pretty much bullied him into it, which I think was kind of funny in the first place. But Jim Vena, it seems that he has a lot of big things in store for UNP, a lot of better execution planned. He was the one who was nominated by the firm itself, so I'm very excited for the future of UNP. I personally do own UNP. With that said, though, a 39% weighting in the portfolio is a little high personally. I would consider selling off now a little bit, getting some gains, especially as it has gone up in the recent weeks. But railroads are definitely a solid industry to be in. High barrier to entry, very hard to compete with, monopolistic features, so much more, and they're always going to be relied on in the United States. Alright, another Joseph Carlson holding, S&P Global, which he currently has $750 worth of. S&P Global is another very strong business. I've done a little research on this one. Financially, everything checks out pretty much. Another tool booth business. Just sit there, collect their fees, do price increases. Next, he's got a tiny bit of money in VU, which is like less than 1% of the portfolio. I would definitely consider selling out of that UNP a little bit, taking some gains there, and potentially dollar cost averaging into that VU, making it a core position in the portfolio. I don't think you could really go wrong there. I'm curious to hear your investment thesis on that mighty $12 investment there. Curious to hear. Next, he's got a behemoth of a company, which is MasterCard, stock ticker MA. Just another tool booth business. Sit there, have your fees, do price increases as Visa and MasterCard have recently actually done. Every time I research Visa or MasterCard, I get even more impressed with the company itself. I think it's an amazing company to have. It's nearly 18% of the portfolio. Definitely approve of it. So I think their buys right now, I think they're being fairly priced by the market, and I think buying great businesses at fair prices, something Warren Buffett obviously talks about. I think it's an acceptable buy range right now. For Visa, at least, I'm buying 230, 240. I think that's fair price. As for MasterCard, I think it's pretty much fair price right now too, especially with their history of buybacks, dividends, and outperforming the total market. And lastly, another Joseph Carlson holding coming at $1,292 worth of the portfolio, which is of course Texas Roadhouse, stock ticker TXRH, and his average price on that is $101.92, and he's only up 3.4% of the position. Texas Roadhouse has been trading really flat recently. I personally just bought in some Texas Roadhouse, $110. If it were to get below $100, I'd probably add more. I can't add, Schwab slices there because it's not in the S&P 500, but I'd like to add some below 105 if I could. Gives you some solid restaurant exposure there. They're also a very strong dividend grower as well. Very simple business model. Treat your employees well, offer good value to the customers, etc. Overall, these are definitely a solid basket of companies to hold for sure. Alright, my honest thoughts. I like both portfolios a lot. The tech one obviously has a lot more money in it, and at big tech, it's really highly concentrated in there, so I would potentially consider, withdrawing some of that money from that 100K portfolio, putting it into the more diverse one with the dividend portfolio, quote unquote, that you want to get that dividend snowball rolling, put some money in there, but you obviously do have a lot of exposure to big tech, a lot of high quality companies in there. But I'm just saying, if big tech were to crash or whatever, like it did last year, it would obviously kind of hurt you a little bit there. You have a lot of toll booth companies, which I talked a lot about in this video, which I think is definitely a good thing as well. One thing I do kind of notice here, there are a lot of Joseph Carlson holdings, which is nothing bad. He probably gave you exposure to those companies to do your own process and research on, which I'm not against whatsoever, and I'm guilty of it myself. I just think it's really noteworthy to a lot of newer investors that might be watching this video. Don't copy stock trades from YouTubers, guys, whether it be me, my target stock, or Joseph Carlson and his S&P Global. Don't do it. Overall, I'd give the portfolio an 8.8 out of 10. Very solid overall. With that said, though, I have to add the extra 3 points because you're a channel member, so that would come out to an 11.8. In all seriousness, though, very solid portfolio overall, very high quality companies in here. I'm happy to see what you're going to do with this portfolio. Obviously, you're aggressively contributing money, $1,000 every week, 55 Genos every year. That's very impressive. So keep it up. Get that dividend snowball rolling right now. Really get that money into that dividend account, and you're going to do great. Alright, guys, that's his portfolio. Let me know your thoughts in the comment section. If you haven't already, join the Discord. Smash the like button, subscribe, and of course become a channel member if you want access to exclusive episodes, behind the scenes content, a stock market competition, and be like William in this video. Become a channel member. Thank you all. Of course, do dividend stocks, not drugs. Have a good one.